Learning objective 2 is all about the preparation of a statement of cash flow. There's two methods in which they can prepare the statement. The most common and the easiest method is the indirect method. So that's what you're going to be learning to do. In order to prepare a cash flow statement, you need a few things. One is you need something called a comparative balance sheets. Now that's the balance sheets from the current year and the previous year. It's a comparison. That's the comparative thing. So you need balance sheets from this year and last year. You need the most current income statement that you have. And there's going to be additional information that's provided to you that's going to help you understand and prepare. Okay. So first things first, one of the most important of all the steps that we're going to be doing to prepare the cash flow statement, the first step is the most important because this is the step in which we have to convert from the accrual basis, which is what we've been doing, to the cash basis. So this is going to be your major issue right here, is understanding how to convert. In essence, we're going to be converting net income from an accrual basis, which is how we prepare the income statement, to the cash basis, which is how we understand the cash flow statement. Okay. So this step is the most involved. This is why we need the income statement from this year. This is also why we need the data from the balance sheets and other data that we're given. Okay, so this is going to be the most critical piece. After we're done with that, step 2 is relative. It's going to be a lot more straightforward because we're going to be analyzing changes in asset and liability accounts when we look for investing and financing activities. The first step is all about the operating activities, which is why the income statement is the focus of most of what's going on there. But the second step analyzes those changes. And that's going to be easier than the first step for sure. The third step is the easiest. We're simply going to be comparing the change in cash from year 1 to year 2. We should be able to identify and understand why there's a difference in the cash balance from one year to another by doing the cash flow statement. Okay, that's going to be the easiest step, the last step. Okay, so we talked a little bit about the fact we're going to be using the indirect method. There's also something called a direct method in which you can use to prepare a cash flow statement. Companies just simply prefer the indirect method. It's just easier. It's less costly to prepare as well. And go back to step 1. It focuses on the difference between the net income of the company and the net cash flow that comes from the operating activities. Remember, net income we get from the income statement. That's why we need the income statement to understand the cash flow from operating activities, because operating activities tend to be revolving around revenue and expenses. So this is going to be part of that step 1 that we're going to be learning. In fact, should be learning right now. All right, so here are the information, piece of information we need an income statement, the most current income statement. So here for this company, the most current one is the year ending December 31st, 2017. And it looks like a single step income statement here. Okay, you've all read this before. This is the first thing we need to note. Notice here our net income is $145,000. Okay, just notice that. The second thing we need is the comparative balance sheets. Again, comparative balance sheets, the most current balance sheet, which would be our December 31st, 2017 balance sheet, compared to the December 31st, 2016 balance sheet. That's the comparison. What we're also going to note on these comparative balance sheets is what has changed from the previous year to the current year. And this is where it kind of gets a little tricky because you have to make sure you're going from the previous to the current. And that's not always easy to do. A lot of people like to just take the difference going the way we usually read is from left to right. So it's oftentimes, but here we're just doing it the opposite. So just note that, something to pay attention to. The most, we're looking at the changes from the most recent to the previous. So you notice these changes are noted in the third column. Cash was $33,000 in 2016. It went to $55,000 in 2017. So there's a $22,000 increase in the cash balance from 2016 to 2017. For accounts receivable, we went from a $30,000 balance in 2016 to a $20,000 balance in 2017. That's a $10,000 decrease. Right? Accounts receivable went down by $10,000 from 16 to 17. Inventory went up from $10,000 to $15,000, so it's a $5,000 increase. And your prepaid expenses went from $1,000 to $5,000, so they increased by $4,000. So you're simply, again, noting the differences, and that's the tricky part because you're going from the previous year to the current year. It's different than how we normally read a book, right? And we're noting the differences on the side. For property, plant, and equipment, we went from $20,000 in land to $130,000. That's a large increase, $110,000 more in the land account. From $40,000 to $160,000, that's a $120,000 increase in the buildings account. Our accumulated depreciation on the buildings went from $5,000 to $11,000. That's a $6,000 increase. Our equipment went from $10,000 to $27,000. That's a $17,000 increase. And our accumulated depreciation on the equipment went from 1 to 3, which is a $2,000 increase. So again, the differences from the previous year to the most current year, noting the differences on the side. So the assets are all set, things to know. Again, we're going to be using this information. Liabilities and stockholders' equity, again, from 2016 to the most current year. So we're looking at the changes from 2016 to 2017, and we're noting them. Right. Accounts payable went from $12,000 to $28,000. That's a $16,000 increase. Income tax payable went from $8,000 to $6,000. It went down $2,000 decrease. Bonds payable went from $20,000 to $130,000. That's a large increase of $110,000. Common stock went from $50,000 to $70,000. $20,000 increase. Retained earnings went from $48,000 to $164,000. That's a $116,000 increase. Okay, so we're noting all of our differences, and that's the second thing we need to do. Right? Income statement, comparative balance sheet. Now, all that additional information, things that we have to know about in order to understand the cash flow statement. First thing we need to know about is depreciation expense for 2017 was $6,000 for building, $3,000 for equipment. Another thing we need to know is the company actually sold equipment with a book value of $7,000, which was their $8,000 cost and accumulated depreciation of $1,000. So $7,000 is the book value. But they sold it for $4,000 cash. So this is how much cash they collected on the sale of that equipment. The third thing is they issued $110,000 of bonds for land. So this land that they bought it with bonds, no cash. It's a non-cash transaction that we talked about last objective. The fourth note is we bought a building of $120,000. We bought that for cash. We also bought $25,000 of equipment for cash. Again, need to know we used cash for that. Fifth thing we need to know is that we issued common stock for cash. So we received $20,000 for common stock. We also paid $29,000 cash dividend. So we used cash for dividends here. So with all that information, now we can start preparing our cash flow statement with step one. Step one, as I mentioned, is the most time-consuming step because we have to convert our net income, right? Our net income, which is from the income statement. The income statement's done on the accrual basis. We have to convert in net income from the accrual basis to a cash basis. That'll give us our cash provided by operating activities. So these are the adjustments that we need to make in order to convert. Okay. First thing we're going to be doing is we're going to be adding back to the net income any expense that didn't cost us any cash, a non-cash expense. The most common one is depreciation expense. When you have a depreciation expense, you're not writing a check, right? There's no cash involved. You've already spent the cash when you bought the asset. Depreciation, as you know, is that process that goes over time. So even though you're able to expense that asset over time as depreciation expense, it doesn't cost you any cash. So we add that back because it literally did not take any cash out of the company. So we have to add it back to net income. The second thing we do is we reverse any gains or losses because gains or losses are part of that net income. Okay. But gains or losses are usually book value gains or losses, not cash. So if we added a gain to get our net income, we deduct it. Or if we subtracted a loss as part of our net income, we add that back. The reason, again, is it's a book gain. It's a book loss. It's not cash. The other thing we need to do is look at those current asset and current liability accounts to see if any of those changes involved cash or not. If they didn't involve any cash, we need to either add or subtract them from the net income. So this is going to be, again, most of what you're going to be spending your time doing here. Okay. So first step, we start with our net income, and the net income from the income statement was $145,000. That's why I circled it earlier. First step, we have a depreciation expense. We're going to add it back in. All right. So we add the $9,000 of depreciation expense back to the net income because it didn't take cash away from the company. So we add it back in because it's, in essence, cash stayed in the company. No cash went out, cash stayed in. So now we've adjusted it by our depreciation expense. Okay, so now our net cash provided by operating activities has increased $9,000, but we're not done. Remember, any loss on disposal of plant assets, it's a book value loss. It's a paper loss. It's not a cash movement. So any loss that we take is added back because it didn't take away cash. And conversely, any gain that we made is deducted. Okay. So in this case, the company had a loss on disposal of plant asset. That was part of our information. And we add that back in because literally it did not take any cash out of the company. So we add that back in. So now we have cash provided by operating activities that has increased to $157,000 from the net income. We're not done yet. We have to look at those current asset accounts and current liability accounts to see if any cash was involved. So it might not look like there is, but there is. Look at accounts receivable. Accounts receivable went down. It went from $30,000 to $20,000. Now, the only way an accounts receivable goes down is because more cash came in to the company, right? Because what is accounts receivable? You're waiting for cash. So if accounts receivable went down, cash went up. So we add the cash back in this step. So any decrease in accounts receivable meant more cash came into the company. So we add that cash back in on the statement. Another thing we do is we look at inventory. In this case, remember, we went from $10,000 of inventory to $15,000 of inventory. If you had more inventory, you had to use cash to buy it. So more inventory, in essence, means less cash because you have to use cash to buy your inventory. So thus, you have to take the cash away. Any increase in inventory uses cash. So that means if we used cash, we take it away. Now, remember when we talked about it in Learning Objective 1, just because a number is in parentheses doesn't make it negative. It simply means cash going out, or the equivalent of cash going out, right? So that's all these means: cash in, cash out. That's it. So again, more inventory meant we had to use cash. Using cash means cash going out. So now look, our net cash provided by operating activities is adjusted to 162,000. Because again, we added in the non-cash, or when we either didn't use cash or we saved cash, and we subtract out when we used it. Now we're looking at prepaid expenses. Now, normally, again, if you have more prepaid insurance or you have more supplies, you have to use cash for it. Okay. So any increase in any prepaid expense, like supplies or prepaid insurance, means that you used cash. So that's a use of cash taken away. Okay. The opposite is true is if it went down. So in this case, we had more prepaid expenses, which means we have to use cash for it. So that cash is reflected here as going out. Now we turn to current liabilities, and we do the same analysis here. Accounts payable is when we owe cash to other businesses, right? So in essence, when an accounts payable increases, we owe more cash. But it's also, from a cash basis, means that we didn't pay out any cash. So as accounts payable goes up, we add that. It's like saving cash. It's like saving cash. So we add the increase in notes payable as more cash staying in the company. The opposite of true is true when a current liability goes down. If we have less income tax payable, that means we had to pay cash. The only way it goes down is if cash goes down. So that means we had to decrease the amount of cash. So here, when you look at this, an increase in accounts payable means we saved cash in the company. Cash stayed in the company. We haven't paid it out yet. So that cash is in. However, a decrease in a payable means we paid down the debt, which means we had to use cash. So that means cash went out. So when we're all said and done, and I think that's the last step, we have net cash provided by operating activities of 172. Now, again, you started with $145,000 of net income, right? We produced net income on an income statement using the accrual method. All of these adjustments are meant to create the cash basis of that. Okay. Did cash go in or out? Or did we save cash? Right. So again, expense, depreciation expense, there's no cash going out. So that's the same as cash staying in. Same thing with an increase in accounts payable. We have more cash staying in because we didn't pay that bill yet. So, it's an interesting way. That's the most confusing thing, but it's an interesting way of looking at uh, business from a cash perspective. So this is a very nice chart. It is in your book. It's clearly part of the slideshow. That basically summarizes step one in a nutshell. So any depreciation expense, we add it back in. Why? Because we're converting net income from the accrual basis to the cash basis to get our net cash provided by operating activities. Gains and losses are simply reversed. Okay. We subtracted a loss out of our income statement using the accrual method. We add that back in using the cash method. We added the gain with the accrual method. We subtracted out on the cash method. And then we just went through our changes for current assets and current liabilities, looking at, did it cost cash or did it save cash? That's how we look at it. Okay. Good chart to know. Good chart to know. So the do it exercise that it starts with here looks at that net cash provided by operating activities. Again, the word provided in this case simply means there's more cash flowing in than flowing out. Here we have a company, Josh's Photo Plus. They had a profit of $73,000, right? Net income, $73,000, of course. They're using that net income was used on the income statement using the accrual basis. So to get the net cash provided by operating activities, we have to convert to the cash basis. So what do we need to know? We need to know that as part of that, we had a depreciation expense of $7,000. There was a gain of $2,500. Then we see that accounts receivable increased, but accounts payable decreased. So they want us to calculate what is the cash provided by operating activities. So our starting point is always the net income, because that's what we're converting. So we start with the $73,000 of net income. Then we go through our adjustments. First thing we do is add back the depreciation expense. So we're adding that back. We had a gain, which we added to get the net income. So we're going to subtract it in the cash basis. Take it away. We had an increase in accounts receivable, which means we're waiting to receive that cash, which is the same as living without that cash. We should have collected it when we sold it, but we didn't. So we're waiting to receive. That's the same as cash going out. We had less of accounts payable. So that means the only way a liability goes down is cash is going out. So that represents cash going out. All of these numbers combined gives us a difference of $3,300 cash flow out. Compare that to our net income. We now have cash provided by operating activities is only $69,700. So here's an example where the cash provided by operations is less than the net income. Oftentimes, you saw back in Learning Objective 1, it's usually the opposite. The cash provided by operating is much higher than the net income. But it can go either way depending on what happened. So step one is going to be the most, that's the trickiest part, which is why they have their own special do it exercise for it. Like I said, step two, step three, I think are going to be much more straightforward, much more easy to understand. Because you can just simply take them at face value. So looking at investing activities and looking at financing activities, they should be a lot easier to figure out. Remember, part of our additional information, the company bought land by issuing bonds. Okay. So you saw an increase in the amount of land correspond with an increase in the amount of bonds payable. This was a non-cash activity. Okay. The purchase of the land is an investing activity. The use of the bonds is a financing activity. So you see these match. It's non-cash. It's not going to affect your cash flow statement, but you will put it on a separate schedule to tell your owners, this is what happened here. This is how we acquired the land. This is why we have more bonds payable. So when you look at cash flow from investing activities, you want to see a company using, buying appropriate fixed assets because you want them to grow. So in this case, the company purchased a building for cash. So you see $120,000 of cash being used to buy the building. The purchase of equipment, $25,000 of cash being used to buy equipment. But remember, they sold off some old equipment for $4,000. Well, that $4,000 is cash coming in from selling the equipment. So when you look at the building, the use of cash for the building and the equipment compared to the 4,000 coming in, they used 141,000 for their investing activities. Okay. Again, the building was bought for cash and the equipment was also bought for cash. Okay. The equipment was bought for cash as well. And if you remember, that sale of equipment brought in $4,000 of cash. That was the cash. Okay. They had a loss for that sale, but $4,000 of cash came in, and that's why the cash flow statement recognizes that cash as cash from investing activity. Okay. So again, the loss on the disposal of the plant asset is adjusted in the operating activity, right? When we do the adjustments to net income, you see that loss is already accounted for. But the purchase of equipment and the sale of the equipment is an investing activity, and you'll see that that's where they're accounted for. Okay, so it's all accounted for, it's just in different parts. Okay. The company raised some money. They sold $20,000 of common stock. So the common stock account increased $20,000, but that's because they collected cash from that. Because it's common stock, it's a financing activity. Finance activities come from liabilities and stockholders' equity mostly. So when they sold common stock, they raised $20,000 in cash coming in. And then, as you know, they paid a dividend. They paid $29,000. That's cash going out. Okay. So in essence, because they had more going out than coming in, they used cash for financing activities. $9,000. So again, those dividends show a use of cash. Right. Okay, so the payment of dividends is noted here. The increase in retained earnings is the profit, the net income from the income statement, which is also noted. So what you have is a difference, right? Sorry, let me go back to this cash flow statement. What you have is a difference in cash. The net increase in cash is the 172,000 from operating expenses minus the 141,000 they used for investing minus the 9,000 they used for financing. Okay, the difference is 22,000. Difference is 22,000. That difference should be accounted for when you look at cash from the last period to the cash to this period. So their cash balance was 33,000. It's now 55,000. That's a $22,000 increase, and this is the reason why it increased 22,000. Now we know why there was an increase in cash. So basically, when you have step 3 is simply just making sure that net change in cash makes perfect sense. Here you have the increase from 33 to 55. That $22,000 increase is all accounted for, right? You understand why it's $22,000, right? It's the operating activities difference with the investing and the financing activities. That should be the difference. And in this case, there's no other activity to show you here. So that's basically the lesson in a nutshell. So again, most of your time is going to be spent on that step one, converting net income to the net cash provided by operating activities. And that's the weird part because you've been used to doing everything on the accrual basis, and now you got to convert to the cash basis. So it's just thinking about the cash flow in a different way. Otherwise, like I said, the other two parts probably made a lot more sense to you. Easy to follow. Any questions?